Okay, so picture this. You're trying to figure out a company's financial health, right? You open their latest report, and bam, just this wall of numbers, jargon. Feels like you need, I don't know, a secret decoder ring just to make sense of it. Well, that's exactly what we're tackling today. Today, we're doing a deep dive into something called GAAP, Generally Accepted Accounting Principles.
Right. That acronym you see everywhere.
We're going to unpack how the pros use these financial statements.
Exactly. Not just, for compliance, but actually finding opportunities.
And spotting red flags. Yeah.
Definitely spotting the red flags. That's key. And the interesting thing is, GAAP sounds maybe a bit heavy, a bit intimidating.
Totally.
But really, it's meant to create clarity. Consistency, that's the whole idea. So our mission today, simplify it, give you a practical, sort of trader-focused view. We're drawing on GAAP for traders to give you that shortcut to, well, making smarter decisions.
Right. We want to give you that foundation, that confidence to look at the official numbers and see them with a more critical eye, make sense of what can feel like a bit of an exclusive club sometimes. Okay, let's get into it. Let's unpack what you really need to know. So, we all hear STOP mentioned, foundational language, right? But for a trader, beyond just compliance, what clarity does it really deliver?
Well, GAAP is essentially the standardized playbook for U.S. public companies. It's the rule book. It dictates how they account for everything. Revenue, expenses, disclosures, what they must report. Think of it as the universal language for financial reporting. Keeps everyone on the same page.
Okay, the rule book. And what does that produce for us? What are the key outputs?
It produces the 3 core financial statements you'll always see. The income statement, it's a loss.
Right.
Yeah. Then the balance sheet and the cash flow statement. Plus, and this is crucial, the footnotes and the MD&A. Management's discussion and analysis.
Ah, the footnotes. Always told to read those.
You really should. That's where the details are. But the main point, consistency, comparability. So you can actually compare company A to company B, real apples to apples stuff.
That consistency sounds great, especially when you need info quickly, maybe for a trade. But how does it directly help us? What's the first tangible insight GAAP gives you?
Okay, well, first off, it gives you the official reported profit or loss, net income, earnings per share, EPS, the headline numbers.
Right.
But maybe more importantly, it gives you that crucial breakdown of cash flow. Operations, investing, financing. Cash flow often tells a truer story than just the profit number.
Okay, so cash is king, even in GAAP.
Absolutely. And beyond the numbers, those disclosures and footnotes, they're gold mines. Seriously. They reveal one-off events, specific accounting choices, lease details, potential liabilities, stuff that's not obvious up front.
The context behind the numbers.
Precisely. Gives you that essential context.
And I assume these GAAP numbers are also the basis for all those financial ratios we hear about, like PE.
Indeed. It's the foundation. Your price to earnings uses GAAP, EPS. Return on invested capital, ROIC. Current ratio. Debt to EBITDA. Now, quick point, you mentioned EBITDA. That uses EBITDA.
Which isn't GAAP, you said?
Correct. EBITDA is a non-GAAP measure. Important difference. We'll get right into that.
Okay, perfect timing. Because this is where it gets really interesting and maybe a bit confusing for people. The difference between GAAP and non-GAAP numbers. Companies report both all the time. Why? And why should you care?
Right. This is a big one. So GAAP, as we said, is the standardized, usually audited, full picture. Everything's in there. One-time items, stock-based compensation, restructuring charges, the works, the official version.
Right.
Non-GAAP, though, that's the company's adjusted view. Things like adjusted EBIT or adjusted EPS. Management basically strips out items they decide are non-recurring or non-cash.
So they're kind of saying, okay, here's the official GAAP number, but here's our version of how we really did.
That's a pretty good way to put it, yeah. They argue it shows the underlying operational performance better.
Can it be useful then?
It can be useful, especially if those adjustments are genuinely one-offs. But, and this is a big but, you have to ask, are they just cherry-picking? Are they excluding things to make the numbers look better than they are?
Ah, the potential spin.
Exactly. So the key takeaway, the absolute must-do, always look at the reconciliation between GAAP and non-GAAP. Companies are required to provide it in their filings. It's your decoder ring. It shows you exactly what they took out and why.
Got it. Check the reconciliation. Don't just take the adjusted number at face value.
Never just take the adjusted number at face value.
Okay, so we understand GAAP. We understand the non-GAAP distinction. Now, let's get practical. How do experienced traders actually use these GAAP numbers? What are some simple, concrete ways you can apply this?
All right, let's talk application. One of the simplest but really powerful checks is earnings quality. You compare cash from operations CFO to net income, straight from the statements.
CFO versus net income.
Yeah.
Okay. What does that tell you?
It tells you if those reported profits are actually backed by real cash coming into the business. Are they collecting on their sales?
So give me an example. Say net income is $100 million.
Okay, $100 million net income. But maybe cash from operations is only, say, $80 million.
Right. What does that mean?
That gives you an earnings quality ratio of 0.8 or 80%. If that ratio is consistently way below 1, like 80% or worse, if it's negative,
Uh-oh.
yeah, that's a big red flag. It suggests earnings might be low quality, driven by accounting accruals like booking revenue before cash arrives rather than actual cash.
So you want cash flow to back up the profit number. Makes sense. Keep it simple. Look at the cash.
Exactly. Cash is reality.
Okay, beyond profit quality, traders often focus on free cash flow,
Yeah.
FCF. How do we get that simply from GAAP? And why is it considered so important?
Super important. And simple to calculate from GAAP. Free cash flow, the basic version, is just cash from operations minus capital expenditures, or CapEx.
So CFO minus CapEx. Got it.
So using your example, $80 million CFO, maybe they spent $20 million on CapEx, new equipment, buildings.
Okay.
Your free cash flow is $60 million. That's $60 million. That's the actual cash the business generated. It's cash that's free to use for paying down debt, buying back stock, investing more, whatever management chooses.
It really cuts through the accounting noise, doesn't it? Just shows the raw cash generated.
It absolutely does. It's a very clean measure of financial health, a go-to metric for many investors.
All right, now for the detective work part. Spotting trouble. What specific accounting red flags can you look for in GAAP reports that might signal problems or maybe aggressive accounting?
Okay, yeah, putting on the detective hat. Several things should make you pause. First, look at receivables. If accounts receivable are growing much faster than revenue.
Meaning they're booking sales but not collecting the cash as quickly.
Precisely. That can signal aggressive revenue recognition, maybe pushing sales hard at quarter end, or even channel stuffing, forcing inventory onto distributors. Big red flag. Inventory. If inventory levels are rising, especially while sales are flat or falling, watch out. That might mean they're struggling to sell products, and a potential inventory write-down could be coming, which hits profits.
Okay, receivables, inventory.
Also, look for strange things on the balance sheet. Large or increasing other receivables, or related party transactions.
Transactions with insiders or connected companies.
Yeah, those always need a closer look. Check the footnotes for details. Transparency can be lacking there sometimes. And remember those non-GAAP adjustments. If a company keeps calling things one-time charges, but similar charges appear quarter after quarter.
They're not really one time, are they?
Not really. It's suspicious. And back to cash flow. If CFO is declining while net income is rising, that's a classic warning sign. Earnings driven by accounting, not cash. You can even use tools like the Benish M-score, a statistical model for manipulation risk, or just look for past restatements. Restatements are serious.
Lots to look for there. Seems like focusing on changes and inconsistencies is key.
Absolutely. Changes, inconsistencies, and anything that doesn't quite smell right. Trust your gut, then dig into the footnotes.
And these GAAP numbers, they also feed into valuation, right? Even if people use non-GAAP sometimes.
Exactly. Your basic PE ratio. That uses GAAP earnings per share. Foundational. And even if you use something like EBITDA, which, yes, uses non-GAAP EBITDA, you always need to reconcile it back. Understand what that EBITDA represents compared to GAAP profit and cash flow. Traders are constantly comparing these GAAP metrics, especially EPS, against what analysts expected and what the company guided for.
That's what moves the stock on earnings day often, right? The beat or miss versus expectations.
Very often, yes. Short-term moves are heavily driven by those GAAP EPS results and the company's forward-looking guidance.
Okay, this is incredibly useful. But putting it all together, if someone wants a streamlined way to read these reports, what's the practical checklist? How do you approach it efficiently?
Great question. Let's make it a simple process. Think of this as your game plan when you open that 10-pay or 10Q. First, quick scan. Look at the income statement, cash flow, balance sheet, get the big picture, then immediately go to the footnotes. Don't skip them. That's where the context lives. The real story often unfolds there.
Okay, scan first, then footnotes. Got it.
Next, check the cash. Calculate that CFO net income ratio, quick earnings quality check, then calculate free cash flow, CFO minus CapEx. See the real cash generation.
Check cash flow quality and quantity. Makes sense.
Then tackle the GAAP versus non-GAAP. Compare the reported GAAP EPS to the adjusted non-GAAP EPS. And critically, read that reconciliation note. What exactly did they exclude? Stock comp, Restructuring. Understand the adjustments. Don't just accept them.
Question the adjustments, okay?
After that, look at specific policies and accounts. Check the revenue recognition policy, super important for software or subscription businesses. Look for big changes in key accounts. Receivables, inventory, deferred revenue, goodwill, intangibles. Are they jumping around? Why?
Spotting anomalies.
Exactly.
Yeah.
Scan for related party deals, any past restatements, or mentions of significant litigation or regulatory risks. And keep an eye on those one-off items. Are they really one-offs? Or a recurring theme management tries to sweep under the rug? Finally, compare cash conversion over time. Is cash from operations keeping pace as revenue grows? You want to see that alignment.
That's a fantastic, actionable checklist. Scan, footnotes, cash checks, reconcile non-GAAP, look for red flags in accounts and policies. Simple, but powerful.
It covers the key bases efficiently.
So we know how to use GAAP, we have a checklist. But what about the traps, the pitfalls? What common ways might companies, intentionally or not, present things that you need to be wary of? How do we simplify risk awareness here?
Right, this is about defense. Understanding of potential manipulation or just misleading presentations. You absolutely need to watch for earnings management. That's where companies try to smooth out results.
How do they do that?
Using accounting choices.
Yeah.
Playing with accruals, setting up reserves and releasing them later, maybe capitalizing costs that should arguably be expensed immediately.
Classifying expenses as assets to delay the hit to profit.
Exactly. It makes earnings look less volatile, potentially masking underlying issues. Also, be wary of big non-cash items. Huge goodwill impairments or massive stock-based compensation costs can make GAAP EPS look awful, even if operational cash flow is okay, or vice versa. Understand the non-cash components.
So don't just react to the headline GAAP number without understanding why it is what it is.
Precisely. Another classic pitfall. Aggressive revenue recognition, especially pushing deals through right at the end of a quarter to hit targets. We talked about checking receivables for that. And finally, circling back to non-GAAP overuse. If a company constantly leans on huge non-GAAP adjustments to make its numbers look good while the official GAAP results are weak,
Be skeptical.
be very skeptical. It might mean the core business, under the official accounting rules, just isn't performing well. They might be trying to distract you.
Okay, earnings management, big non-cash items, aggressive revenue recognition, and especially non-GAAP overuse. Got it. Key risks to watch.
Wow, we've really unpacked a lot today. We've tried to take something that feels complex, like GAAP, and make it simpler, more actionable for you. It's really clear that GAAP is the baseline, isn't it? It's the official starting point, the required truth.
It absolutely is the foundation. But remember the big picture. GAAP gives you that foundation, but it's rarely the whole story by itself. You now have the tools, hopefully, to dig deeper, to reconcile GAAP with non-GAAP, to really scrutinize those footnotes. You know, for short-term trading, yeah, the market often reacts hard to that GAAP EPS number and the guidance, that's the game. But for longer-term investing, it's the strength of the cash flow, the health of the balance sheet things revealed by a careful GAAP analysis that truly matter over time. So, wrapping this up, what does this all mean for you, the listener? It means understanding these fundamental principles, even at a simple level, gives you a seriously powerful lens to look at any company. The real skill isn't just knowing the rules exist. It's being able to question them, interpret the numbers, and see beyond just the headlines or the adjusted figures. With this deep dive, hopefully you're not just reading numbers anymore, you're starting to understand the story they tell. And maybe, just maybe, the story they don't tell. Keep digging, keep asking questions, and keep making those informed decisions.